Hi friends, in this video we are going to discuss about some of the few questions from business finance which is asked in October 2020 exam. Okay, so there are certain questions which you can expect every time for the exam. Okay, like there will be a question from cost of capital, then dividend theory. From the part of dividend theory, it can be for computation of dividend, price of calculating shares, or it is about some theory like Walters and Gordon's approach. Then there are certain questions you can see from leverage area, then leasing. All these are very important questions from the area of business finance. Okay, anyway, we can deal with some of the questions, at least 5 questions from this area. So let's start. Yeah, this is the first question. The question goes like this: arrange the following financing choices in order of preferences suggested by the pecking order theory. And the options are reinvestment of earnings, new issue of equity, issue of debt. So this question is actually you have to arrange these options. That means this is all related to different sources of raising funds based on pecking order theory. So for that you should know what is pecking order theory. Okay, and here we have the options like 1, 2, 3. You have to just arrange in the order which one is more preferential, then the next one and the third one. So like a way you have to arrange. Anyway, the pecking order theory, this theory is actually related to capital structure of a company. What do you mean by this capital structure? Capital structure means it is a combination of different sources which the firm uses for raising funds. Like a capital structure of a company includes equity share, preference share, debentures, retained earnings. All these can be a part or a component of a capital structure. Okay. Now this was initially suggested by Donaldson and it was popularized in 1984 by Mayers and Majloff. Okay, and this theory actually saying that about how to choose or the order how you have to raise the finance from different sources, the hierarchy of raising funds from different sources, that is actually dealt by or dealt in under this pecking order theory. See, the hierarchy gives first preference to internal financing. So according to this theory, or this theory suggests that firstly you should go for internal financing. That means about plowing back profit or retained earnings. What do you mean by this plowing back of profit or retained earnings? That means a portion of a profit that you have been retained in your business for future purpose, maybe for some future project or investment. So that is considered as retained earnings. Okay, so this is an internal financing, right? Because we finance from our business itself. So this is called internal financing. So as per pecking order theory, it is suggested that firstly you should go for a internal financing. Then only if that amount is not sufficient for you, then only you should go for a external financing. And in case of external financing, firstly what you have to choose? Firstly you have to go for a debt financing. Then only you have to approach equity. Equity should be your last option as per this theory. Okay, why he arranged in such an order? This is because he used cost of capital as a term for analyzing all these the hierarchy, not to make this hierarchy, because when we are taking from internal financing, we can see that the cost is much more lower comparing to other cost of debt or cost of equity. See, the cost of equity is more because it is more riskier one. So more risk means you should get more return, right? Yeah. So what do you mean by this cost of capital? Cost of capital means it's a minimum rate of return that you're expecting from the investment you have made. So for an equity shareholder, he is taking more risk. So as a part or in return, he needs more return. Okay. So he is expecting more. So cost of capital or the cost of equity capital is more. But comparing to cost of debt, what is the case of cost of debt? Cost of debt means the interest that you need to pay to your debt, debenture holders out there. So in such a case, as we know that the interest is a tax deductible item, the cost of debt is much more lower comparing to cost of equity. See, so if you are going for this debt, they are saying that you can anyway, first you are going for internal financing, then you have to go for debt, but we are not able to use debt for more contribution. Like you should be within a range. If you are rising the source, rather than that, what will happen? Your firm needs to pay lots of cost that much amount of fixed cost you have to pay, that is fixed interest payment you should do, and in such a way that is a suffering for that particular concern, because they have to make a huge amount of interest if they are depending so much on debt. So you can depend on debt, but up to a certain level, okay, how much that you can bear as you have to make payment, interest payment. So anyway, if you are using after a point, that will be more riskier, so don't do like that. Anyway, first you have to go for internal financing, then up to a certain point you can go for debt, and again you need more fund, you have to go for equity shares. So in this chart you can see that how this hierarchy is there as per pecking order theory. First you have to go for internal financing, that is about the retained earnings. Then you have to go for external financing. Your first option should be debt. After that means you are using debt up to a certain level, then you can go for equity. Again you need fund, you can go for equity. And how this actually these sources are arranged, this is actually based on the cost of capital, how the cost is going in this. Okay, like for an internal financing, cost is much more lower comparing to debt, it is greater than internal financing, even though it is lesser than equity, and the most cost is going to equity as they are taking more risk. Okay, cost of capital or cost of finance will increase as per the increase in case of a risk. If you are taking more risk, that means you should get more return, right? So here the equity shareholders are taking more return as they are the owners of the company. So in such a way that they should get more cost. Okay, so that is about the cost of equity. So this is a way how the pecking order theory is saying about the hierarchy. And coming back to our question, the first one will be reinvestment of earnings, and second one will be issue of debt, and finally new issue of equity. So the order will be 1, 3 and 2. Yes, option C, 1, 3 and 2. Now the next question, in which of the following situation the payback method is advised for evaluation of investment opportunities? So this is about a payback period. We know that it is one of the oldest method of, or the historical method of capital budgeting decision, and here the question is which all firms or which of the following businesses actually should go for or suggest this payback period. So for answering this question, you should know what is payback period and what is the benefits of payback period. See, what do you mean by this payback period? So payback period is actually a technique. What technique? It's a capital budgeting technique, and why it is used? It is used to calculate the time period which is required to earn the initial investment of the project. Okay, that means how much period you need to get back the amount that you have invested in a project. So the project or investment with the shortest duration is actually opted, or the shortest duration will be we will always choose. This is because we will get the return so much fastly comparing to the other project. We will go for the first one, the project with shorter payback period. So this is considered as a most common and simple method for calculating capital budgeting or taking capital budgeting decision, and it is also known as payout method or payoff method. So this is considered as a crude method which can be used for finding or choosing a project. Okay, so how you are choosing this payback period is calculated based on an equation, and the equation is like this: total investment divided by annual cash inflow, and this cash inflow means it should be before depreciation and after tax. So that cash flow should be considered. See, I will just give you an example to make it more clear. Here project A cost rupees 2 lakh and project B cost 3 lakh. Both have a 10-year life. Uniform receipts expected are A rupees 40,000 per annum and B 80,000 per annum. Find the payback period and advise which project to go for. Here we have two projects. Project A which cost is 2 lakh and project B its cost is 3 lakh. And coming to your cash return, cash inflow, annual cash inflow for project A is 40,000 and for project it is 80,000. So here which project you should choose, that is a question. So for that you can use payback period. How we are using? See, for project A, how we can calculate? We have the equation that total investment divided by annual cash inflow. For project A, the total investment was 2 lakh And what about the annual cash inflow? That was 40,000. So 2 lakh divided by 40,000, you will get 5 years. That means you need 5 years to get back the amount that you have invested in that particular project. Okay, so the payback period for this project A is 5 years. Coming to project B, you can see the total investment was 3 lakh and the annual cash inflow from that were 80,000. So 3 lakh divided by 80,000, which will give you 3.75 years. That means you need only 3.75 years in order to get back this amount, that is about to this 3 lakh. Okay, so in such a case, we will always go for project B. See, here we need much less years comparing to here. Project A needs 5 years, but in case of project B only 3.75 years. So for a concern, it is beneficial to go for project B if we are considering payback period, because in this case we will get the amount that we invested in business with 3.75 years. But if it is a case of project A, you need 5 years. Okay, so with that you can go for project B as payback period is much more lower. Okay. Now again, coming back to this question, see, this question was which of the following situation the payback period is advised for the evaluation of investment opportunities. So which type of business is actually go for payback period? So let's take the first item, that is over leveraged business. What do you mean by this over leveraged business? Over leveraged business, the term over is very important. Over leveraged, that means it's more than the limit that they can take. Such a limit is actually initiated by this business. So there is more debt is actually included in the capital structure of this business. So that is an over leveraged business. So that business is always under a risk because it is over leveraged. Okay, in such a situation, it is not a balanced leverage, it is over leveraged. Okay, in such a situation, there is much risk is there. So for a risky firm, it is better to get back the amount that they invested as much as earlier as possible, right? So you can say that option A, that means for a payback period, or if your concern is an over leveraged business, you can use this payback period. Okay. Then what about cash rich business? Cash rich business means there is no problem with their liquidity. They are well flourished firms. So there is no need to, they may not going to depend on this payback period as they have funds for future investments. For such a business is not going to make or depend on this payback period. And next one, uncertain market condition. Yes, if the market condition is changing or you are not able to predict the market condition which is happening in environment, then it is very difficult to wait for some investment, right? So in such a situation, it is better that as the market is always fluctuating, you always go for getting the amount as much as earlier as possible, right? So in such a situation also you can choose for payback period as you will get the return earlier. So such a firm is also a risky area, so they will also go for a payback period. And what about stable market condition? If the market condition is stable, there is no much risk in such a way that they can choose other method also. So which all option you can go for? Option A, over leveraged business, and option C, uncertain market condition. So option A and option C, under these two situations, payback period is the best as both these firms face risk, and for them it is better to get the return as much as earlier as possible. So option A and option C. Okay. Now the next question, so this is an assertion reasoning question. So coming to assertion, firms opt for buying an asset if the equivalent annual cost of ownership and operation is less than the best lease rate it can get. And the reason, operating leases are attractive to equipment users if the lease payment is less than the user's equivalent annual cost of buying the equipment. So with this you have to choose the options. So anyway, by seeing this question you can see that it is actually related to leasing. So you should know what is leasing. Okay, leasing is actually an agreement between two parties. One is lessor and other party is lessee. Lessor means the owner of property and lessee means the user of property. Okay, so leasing is a general agreement or general contract between owner and user of the asset over a specified period of time. And here the asset is purchased by the lessor. That means he is a owner. He is also known as leasing company. If it is a case of company, that company is known as leasing company, who is the owner of the asset, and thereafter leased to the user. the person who is taking that asset for lease is actually known as lessee or lessee company, which pays a specified rent at periodical intervals. So these lessees needs to pay lease rentals to the lessor as they are taking that particular asset on lease. Okay, that is a payment that they have to make to the owner. The owner means the lessor. Okay, so this can be considered as an alternative from the part of lessee whether to buy a particular asset or whether to take it on lease. Okay, he will choose whether to purchase or whether he needs to take it on lease based on comparison. That means if he found that if he take a particular asset or if he bought a particular asset, he needs to make a rupees 5 lakh, and if it is about lease rental, if he is computing the total amount, that is only 4 lakh, then he can go for leasing, right? So this gives actually an option for the lessee either to buy or to lease a asset. Now we have different types of leases. Okay, operating lease, finance lease, sales and lease back, leveraged lease, sale aid lease, close-ended and open-ended lease. See, all the types of leases are very important, and there were lots of questions were asked from each of these types. Okay, especially about leveraged lease, sale aid lease, finance lease, operating lease, all these types of lease. Anyway, we have discussed in very detail about all these leases in our LMS platform. Anyway, now coming to the first category, as the question here we can see operating lease. I will just discuss you what do you mean by this operating lease. So operating lease means you are taking the lease for a short period. Okay, that means the lessee is taking that lessee is taking or making a contract with the lessor for a short period of time, maybe for 1 year or 2 years, then you can consider that is a case of an operating lease. Here this type of lease is also called callable or cancelable lease, because this can be cancelled by the lessor at any time, but with a prior notice. Okay, they have to make a notice, but it is cancelable. While comparing to finance lease, such type of leases are not cancelable. Anyway, in this case, the lessee, he will make the lease payments and after lease rentals, okay, he will make the lease rentals periodically, and after the lease period is completed, he will return back the asset to the lessor or the owner of that particular asset. And here, see, which company always go for operating lease? If they want to make lots of updation, or if they want their asset not to be an obsolete one, they can go for this, because this is a short term period lease. Okay, in such a way that it is very beneficial for such concern. If they are making buying always, that will be very difficult for the concern. If they are using this type of lease, as they can use a particular asset for 1 to 2 years, then if that particular as a company wants to choose another machinery, they can go for that. Okay, so this is a case of a operating lease. So coming back to our question, in this assertion, firms opt for buying an asset if the equivalent annual cost of ownership and operation is less than best lease rate it can get. That means from the part of firm, if the firm is comparing two options, that is either to purchase a particular asset, if they are considering the purchase price or ownership cost, they found it is much more less while comparing it to the cost related to leasing or leasing a particular asset. So they found it is more beneficial, or the cost for ownership is much more less comparing to the lease. Okay, in such a way that firm will surely choose buying an asset, because lease rental is more comparing to the cost of ownership. So in such a way that they will surely go for buying the asset. That is the first assertion. So assertion is correct. And what about reason? Operating leases are attractive to equipment users if the lease payment is less than the user's equivalent annual cost of buying the equipment. Now this is from the part of lessee. Okay, like if the operating leases are attractive to equipment users, so for which type of equipment users operating leases will be beneficial, or it will be attractive if the lease payment is less. The payment that they have to make, that is the lease rentals, is much more lower when comparing to the payment that we need to make for buying that equipment. That means for buying, if they needs to pay more while comparing to lease payment, they will go for lease rental. Yes, right, because now, and in the reason it is suggested that they will go for operating lease if they found that the payment that they need to make for lease rentals is low comparing to purchasing that particular asset. Yes, in that case reason is true. Okay, and now for every assertion and reason question, the first thing you have to go is whether the assertion is correct, then you have to check reason is correct. Now another important thing is that you have to find whether this reason is supporting this assertion. See, the assertion is saying about the buying a particular asset from the part of firm, and now this is about from the part of an equipment user. Both these have some connection as both these are suggested about leasing, but it is not connected. Like you can't say that the firm is choosing for ownership or the firm is choosing for buying that particular asset because of this reason, because reason is from the part of an equipment user and assertion is actually from the part of firm. So both these are from different dimensions, so you can't connect them. Okay, so anyway the assertion and reason are correct, but R is not the correct explanation of A. That is option 2 is the correct answer for this question. Now moving to the next question. In this question, suppose that a firm has 20% debt and 80% in its capital structure. The cost of debt and cost of equity are assumed to be 10% and 15% respectively. What is the overall cost of capital? See, this overall cost of capital, or you can also call it as weighted average cost of capital. See, here we have the options which is related to cost of debt and cost of equity. So the question is all about the capital structure of the company, and here we have the options related to the debt cost and equity cost. Okay, so with this you have to compute the overall cost of capital, that means which is about the weighted average cost of capital. So for that you have to maintain the weight. Okay, weight means it is actually saying about the proportion of each and every sources to the whole contribution or to the whole of that capital structure. Anyway, we can do this question. So the question is 20% of debt and 80% of equity in its capital structure. That means in the capital structure 20% is actually contributed by debt and the remaining 80% is by equity. Okay, so 20, 100, we know that that is 100, total proportion is 100. Okay, 20% of debt and 80% of equity. Then the cost of debt is given as 10% and cost of equity is 15%. Okay, so cost of debt is 10% and cost of equity is 15%. So this the proportion or the amount that actually contributed by debt and equity, that proportion is actually termed as weight, W, and X means the cost of debt and cost of equity. Cost of debt is given as 10% and cost of equity given as 15%, and now you have to compute WX, that means you have to multiply these two items. So you have to take it as like this only, 20 into 10, that is 200. Now 80 into 15,200. Okay. Now you have to take the total of this WX, that is 200 plus 1,400, that is 1,400. Okay. So we have sigma WX. This is sigma WX, right? As which is the total of WX. This is sigma WX, and this will be sigma W, the total of weight. Now for calculating weighted average cost of capital, we have the equation sigma WX divided by sigma W, okay, which is equal to sigma WX means 1,400 divided by sigma 100. So you can cancel. So your answer will be 14%. Okay. So here we have the proportion. Firstly you have to take the proportion, and this proportion is actually considered as a weight, and the cost or X is considered as the cost of debt and cost of equity. Then you have to multiply this item, that will be WX, and you have to take the total of WX, that is 1,400. Then the equation for finding weighted average cost of capital is sigma WX divided by sigma W, that is 1,400 divided by 100, which will give you 14%. So moving to another question. A Limited has a share capital of rupees 5,000 equity shares of rupees 100 each. each having a market value of rupees 150 per share. The company wants to raise additional funds of rupees 1,20,000 and offers to the existing shareholders the right to apply for new shares at rupees 120 for every 5 shares held. What would be the value of right? So this question is actually about calculating the value of right shares. Okay. So what do you mean by this right shares? Right shares means it is actually giving an opportunity or a right to the existing shareholder to subscribe from the to subscribe when they are issuing new shares. Okay. At a special price also. Okay. So in this question we have the market price is 150 and the right price for the share is 120, and it is given that the one share will be allowed for the shareholders who hold 5 shares. So one share for every 5 shares they held. Okay. That means a person with 5 shares can purchase 1 share. That is the thing. Okay. Now coming to this question, or the way you can calculate value of right shares with this equation. There are different equations for calculating, but the most simple and easy technique is this one. Okay. So market price minus price of right shares divided by n plus 1. So market price in this question is given as 150. Okay. You can see the market price of the shares are 150. And what about the price of right shares? That means the price at which the company will sell the shares to their existing shareholders, that is given as rupees 120. And now n means the number of shares that they held. That means it is given that for every 5 shares, how much shares will be there? 1 shares will be given. Okay. For every 5, 1 share will be given. That means the number of shares that a particular person hold, 5 will get 1 more. Okay. This 1 means that is based on this 1, and for every 5 shares that they held, for every 5 shares they are getting 1 share. Okay. So n means that one itself. So 5 plus 1. Okay. So 150 minus 120, which you will get 30 divided by 5 plus 1, which is 6, that is equal to 5. So the value of right share is rupees 5, that is option A is the correct answer. Okay. So see, this is a way how you can calculate. You just go through this equation only, then you can solve this question very easily. Okay. That only you have to take is the market price and the price of right shares. So that was given as 120 and the market price of the share is 150, and n means the number of shares that they have to, or that the company is considering. Here for every 5 shares they will be allowed 1 right share. So that is, so the number n is 5 and 1 plus 1, 30 by 6, that is 5, that is option A. So in this video we have discussed about some of the few questions from the area of business finance which were asked in recent exam. So when you go through this question, you can see that in every exam you should have, or you will have a question which is related to cost of capital. So cost of capital is very important, and you have to go through each of the equations which is about cost of debt, cost of equity, cost of preference share. All these are very important. Anyway, this time they were asked about calculation of overall cost of capital. So that is a short question. So you should study such types of question, and I hope this video will help you for your preparation of Nta Ugc, Net and JRF. Happy learning. Thank you.